Imagine playing a game of Monopoly and all the properties have gone up for sale. Mayfair, Park Lane, Bond Street, you name it, it's up for sale. And yet, despite the fact that they're all 50% off, most players can't afford to buy anything. Some of them, in fact, can't even afford rent at Old Kent Road. And yet, in spite of all of this, one or two players were quietly stacking cash the whole game, waiting for this exact moment, an economic crash. And this video is about which player you're going to be. Are you going to be the hunter or the hunted? So first of all, we need to understand, what does a financial collapse actually look like? Well, first and foremost, homes cannot be sold. So for example, in 2008, because of the housing crisis, you'll see whole roads where all the homes are for sale, and yet none of them are being sold. Now, why is this actually happening? Because number two, mass layoffs. When people en masse lose their jobs, they still need money to survive. And they sell the most expensive things they have. So for example, their home. And when they cannot sell it, things become very, very desperate. As I've mentioned here, desperation starts to increase. And the fact that there are mass layoffs and you're unable to find new work means that if you actually have a job, even if the conditions get worse, you still stay there, or you hope to just stay there, because at least you have some money coming in every single month. And this just increases the spiral and the doom loop of desperation. And something that's very important for you to understand in a financial collapse is that your money no longer goes as far. Now, why is this? Well, in most cases, the government has ran up a debt or a deficit that's just unsustainable. But inevitably, it has to pay back those that have lent the money. So what typically happens is the government prints money. And when the government prints money, because there's more money in the money supply, your money is just worth less. For example, why are Ferraris worth as much as they are? Because there is a very small supply and yet there's a very high demand. Think of the same thing with money. When the supply is just inflated, when the supply increases 10 to 100 times, well, naturally it's just worth less. And the most notable example of this was in Germany in 1923, where the government was struggling to pay back its debts. And someone thought it was a brilliant idea. Well, what if we just print the money and give it to them? They were like, wow, this is incredible. So they started it, and we all know what that led to. It led to hyperinflation in Germany, where one day the bread went from 250 marks in January 1923 to, by the end of the year, specifically in November 1923, it went to 200 billion marks for a loaf of bread. And there's this picture of a German man with a wheelbarrow carrying 200 billion to go and buy a loaf of bread. Absolutely ridiculous scenes. That's why historically, debt and all these governments dealt with gold. They would pay each other with gold because there's only a finite amount and you cannot print it. You're actually paying the amount that you actually have to pay. As when you print the money and you give them the nominal sum, because the agreement is, for example, 5 billion marks, you are paying the 5 billion marks, but it's just worth nothing, right? And that's the problem. And in extreme cases of financial collapse, we get violence. So most notably in the 1990s during Eastern Europe, it was like the Wild West, where mafia bosses would just shoot each other every single day. Bulgaria, Romania, Ukraine, Russia, all the countries. And this is just very frightening to be a part of, because if you're a normal citizen, if you have to dodge gunshots, this is a very scary time and place to be alive. And with this all being said, let's compare to how things are now. So how are things now? Well, unemployment is on the rise, unfortunately. Microsoft recently let 4,800 employees go, Meta let 3,600 go, and Volkswagen, the world's biggest manufacturer of cars, the world's biggest car company, is letting 50 to 100,000 people go. 50 to 100,000 people go. That's like letting a whole town go. Imagine the whole town becoming unemployed at once. And the bad thing is, they won't be able to find another job because the economies worldwide are slowing down. They're entering recessions. I mean, they actually are in recessions, but officially they're not yet somehow. And what are they going to work now? So unemployment's on the rise. Youth unemployment is on the rise. NEET, not in education, employment or training, is on the rise. It's roughly 1 million people in the UK. 1 million people. That's roughly the population of Birmingham. Imagine the whole of Birmingham being unemployed. That's a staggering burden for the country. Societal norms and morals, definitely on the decline. I don't think anyone can argue against that. We have far more robbery than before. And disregarding robbery for a second, just when you walk on the streets, what do you see? You see litter, you see rubbish. It's not clean. People don't care about their communities. They don't care about their neighbors. It's not what it once used to be. Everyone's very individualistic, very selfish, right? And this is a typical sign of a dying society. Not just about a financial collapse, which was the prior slide, but as a society as a whole, when things are going badly, that signals that the country itself is in serious trouble. Productivity. Productivity officially has been stagnant from 2008. But I think everyone knows that honestly it's been on decline since 2008. Because really think about it. What has the UK pioneered? What has it improved in? Absolutely nothing. Like, let's be honest. There's nothing where you have a think, oh, what did the UK pioneer? Yeah, nothing. In fact, if you think about countries that are pioneering things, you think about China. And now, most importantly, purchasing power. Purchasing power is in freefall, unfortunately. How much was a Freddo 10 years ago? 25p. Now, 35 to 40p. As a percentage, that's a staggering increase. That's roughly 50% increase. What does that actually mean for you though? That actually means that your salary is now 50% more worthless. That means that even if you're earning 40k, which is a little bit above average by the way, that means that it's actually worth 20k 10 years ago. So even though nominally you're staying at the same level, in reality, they are making you poorer. And this is very common of a late stage debt cycle. So before I cover short-term and long-term debt cycles, we need to go through what are crashes, recession, and depression. So let's get into that now. So listen up. We're now going to cover crashes, recessions, and depressions. It's very important for you to know the difference between the three of them. So let's get started with economic crashes. So as I've written here, it's a dramatic drop in financial markets, and it's usually like a blip. And it happens very, very quickly, usually within a few hours or days. The most notable example I can give you is Black Monday, where on the 19th of October in 1987, the Dow Jones Industrial Average fell by 22.61%. That is a staggering feat in just one day. That also signifies that loads of people lost significant wealth during that time, because imagine seeing your portfolio from being up a substantial amount to suddenly being negative all in one day. That can lead people to do insane things. So it's very important to stay level-headed during such times. Next, we have recessions. A recession, as I've written here, is just a slowdown in business and jobs. And the official definition is where you have 2 or more quarters where the GDP is shrinking. And as I've written here, it usually lasts a few months to max a year, typically. And this is a typical cycle of the boom-bust cycle. And typically the economy picks up again after. But this time it's going to be different, because this time we've reached a point of no return. What we're going to have is the 2028 financial collapse. And this will be a depression. So it'll be very painful, and it's a very severe recession. This typically lasts a few years, and honestly it's very painful because loads of people lose their jobs, their livelihoods, and people become very, very desperate. Global trade collapses, and a depression is characterized as where more than 10% of the GDP has shrunk. For example, during the Great Depression, almost 100 years ago now, in 1929, the Wall Street crash, which led to the Great Depression, how much do you think the US economy shrank by? In fact, I'm going to make a quiz right here. I would like you to answer it. I'm continuing now. It was 30%. 30% in 4 years. Loads of unemployment and lots of people that were very, very desperate. It's a very unpleasant period to live through. And it's very important for you to understand short-term and long-term debt cycles. In fact, I think this is the most important thing that you need to learn from this video. So let's cover this now. So by understanding short-term and long-term debt cycles, you will understand where we are and what to expect next, essentially allowing you to predict the future. So short-term debt cycles typically last 5 to 8 years, whereas long-term debt cycles last 75 to 100. And to save time, I'm just going to cover the big cycle. And the big cycle is where initially, and this was in 1944 for our current big cycle, the New World Order begins, where the US is established as the world's global superpower. And there's peace, prosperity, and there's productive debt growth. Initially, the debt being used is actually used to fuel industries, to accelerate and move humanity forward. But financial bubbles start to form and big wealth gaps start to exist. And incomes rise and competitors copy. So in our case, who would that be? That would be China. And naturally, we start to overstretch. And now we start going on the way down. The financial bust and economic downturn starts to worsen things for most people. That was 2008. But in 2008, they managed to stop what was actually meant to happen, which was essentially a 1929-esque Great Depression. And how did they do that in that case? Well, they printed a lot of money and gave credit. Now, if you follow the news, you'll know that Scott Bessent ordered the Treasury to buy back some of its own bonds. And how would it do that? Well, essentially through QE. If you watch the prior classes, you'll know what that is. But just to keep it brief, essentially the government prints its own money and buys back its own bonds. And what that does is it keeps the interest rates steady. It keeps them, it suppresses them basically. Because if the interest rates become too high, everything will collapse. The whole economy, the global economy as we know it, will collapse. Hence why they're taking drastic measures to suppress it. Also, what do we see? We see that revolution and wars occur. Hence why they started the war in Iran. The reason being is because they need to maintain the illusion of the American empire being very strong. But we can all see that that's failing. And also, what typically happens is these wars, World War I and World War II, mask economic downturns, and they actually get the blame as to why the economy collapses. And this war, in my opinion, will be no different. I believe that the Iranian conflict was started to mask the incoming economic collapse. And then, inevitably, debt and political restructuring occurs, and then we get a new world order. So now this begs the question, why now? And now we're going to cover that. So, why do I think the crash is now? First and foremost, it is now. But there are four main reasons as to why. The first reason, stock price valuations are higher right now than they were in 1929. And what happened in 1929? The Wall Street crash. And in the year 2000. And I need not remind you that in 2000, after the dot-com bubble burst, Nasdaq lost 78% of its value. 78%. So much money was wiped away. Trillions of dollars lost. Second reason, young people can barely survive, let alone buy a house and start a family. And this is crazy, when the first time in human history, it's not just in one place, but in the whole world. In the whole world, young people cannot buy homes and cannot start families. Thirdly, this is a very, very, very important thing that you need to understand, is that nations' debts are so big that it is impossible for them to pay it back. This is just a massive Ponzi scheme where they keep giving loans to each other. And the reason why the US intervened in the Japanese yen is because they need Japan to keep buying those treasuries to prop up the whole system. If the GCC and Japan stop buying US treasuries, do you know what will happen? Tomorrow the economy will collapse. The whole worldwide economy will collapse. The global economy will truly be finished. Hence why the US is trying so hard to prop up the Japanese yen. And fourthly, and if you watch my prior class on the dot-com bubble burst, you will know that this is exactly what happens pre-crash. There are a lot of IPOs, especially of unprofitable companies. So SpaceX, for example, recently IPO'd, and it's an extremely unprofitable company, and yet it's the world's most valuable company. Also, I haven't written it here, but Anthropic is planning to IPO very soon. And they, although they're doing very impressive things with their company, they are also unprofitable. So, have a think to yourself. If you know that you're unprofitable, but you also know there are lots of people willing to buy, what would you do? Would you sell at the top or the bottom? Well, obviously at the top, when the bubble's reaching the top, right? Hence why all these companies are IPOing now. So this shows you that in a few months' time, that the crash will occur. But I believe that the effects will truly be felt in 2028. Also, we can see that the house prices have now hit their peak. In 2026, in Q4, house prices will no longer rise. They will only go down from here. This is one of my personal predictions. And with all that being said, I'm now going to teach you how to predict a crash. So how can you predict a crash? Well, there are 4 main indicators that I use that are very reliable in my opinion. The first one, and this is my favorite one, an inverted yield curve. Now, what does this actually mean? Well, let me show you. So, typically, a long-term bond carries a higher interest rate than a short-term bond. Now, why is this? Well, because naturally, it's riskier to hold something over a longer time than a shorter time, as more can happen in that time frame. So, for example, a 10-year bond will typically have a higher interest rate than, say, a 3-month bond. However, when it's inverted, when the short-term bond has a higher interest rate than the long-term bond, what that means is that the market is factoring in worse economic activity in the long term. Hence why the short-term bond actually has a higher interest rate than the long-term bond. Next, asset prices decouple from fundamentals. So what does this mean? So, for example, if the average house price is 500k in the UK, and let's say, even though it's not this, that the average wage is 50k, that's a ratio of 1 to 10. So your house price is 10 times your salary. A healthy ratio is 1 to 3, 1 to 4, max 1 to 5. But we're well above that. And bear in mind, this isn't actually the average salary. The average salary is 37k. So this is actually even higher, signaling that basic needs cannot even be met. Also, stock price valuations are, as I already mentioned, at the levels of 2000 and 1929. And in fact, we've surpassed them, which shows that the market is heavily overpriced. A very common thing is when people say this time it's different. That's a very good indicator. So let me give you a few examples. Most notably, as I already mentioned, in the year 2000, on the onset of the internet, everyone was like, oh, this time is different. This is going to change the world. It's going to be great. And then in 2000, the Nasdaq plummeted 78%. Whilst they were correct that the internet would change the world, as you're literally watching this through the internet, and thanks to it, inevitably every bubble has to burst. Another very common bubble that's spoken about is the railroads. Now, the railroads changed humanity forever. Thanks to railroads, we have managed to progress so much as a civilization. However, even though everyone was betting on them that they would change the future, and they did, the bubble burst and lots of people were burned. And this is also a very important one. Credit spreads are widening. Now, what does this actually mean? So this is corporate. So corporate versus government. So when things start to get worse, investors as a whole stop putting money in corporate bonds as they think there's a higher chance of the company going bankrupt or failing to pay back its bond. And so they go to the safe place, the government. Now, why is it actually seen as the safe place? It's because the government will definitely pay you back your bond. But the problem is that the government may print money to pay it back. However, people think that this is an unlikely scenario because if the government were to do that, the whole economy would collapse. Hence why they go from corporate to government. I must state that no indicator is 100% accurate, but these 4 indicators are very useful in predicting what's about to happen. But where most people see adversity, I see opportunity. And I'm going to tell you why crashes are actually good. So, you heard me right. Crashes are good, but only if you are informed. And this principle is the principle that you need to apply throughout this whole slide. So when you lose money, somebody else gains it. And now I want you to look at this slide through that lens. So crashes allow smart money to take dumb money on a scale that is honestly unimaginable. It's a once in a lifetime opportunity. And that is what I'm telling you this video. This is not a doom video. This is a video for opportunity. What's about to happen in the next 2 years will probably destroy 80 to 90% of the people on this planet. But you can be part of that 10 to 20% that takes advantage of what is happening, because you know what is about to happen. So you can take the correct steps to get ahead. So now remember this principle, and we're going to apply it here. So when your index fund crashes, what happens? You lose out on money, right? If you're in the fund, your index fund has gone down, and subsequently your money is going down. And in fact, you may end up negative. But what has actually happened? Well, the people that were informed, they shorted and they took your money. So when you lose money, somebody else gains it. Most notably, John Paulson in 2008. He saw that what was happening was completely unsustainable, and he knew that he had to short. He made $20 billion. That's right, $20 billion. And he personally made $4 billion. So his company made $20 billion from that short, but he personally made $4 billion. That is generational wealth in 1 year. Obviously, he had a lot of capital beforehand, and I'm not saying that you can earn 4 billion unless you already have billions, to be honest. But what I'm saying is that when you're informed, you can make a substantial amount of money that could change your life. I'm not promising you billions, not even millions. But if you're very, very informed, and if you have enough capital, you can definitely change your life. And this is the sad part about it. Most people lose everything, but those that are informed are the ones taking it. So when people are selling their houses en masse, selling their cars, all their possessions, they're very desperate. And what that means is that they're willing to sell for a much lower price than what it's actually worth. And those that were informed, those that have cash reserves, they can come up and sweep it all up for a fraction of the price. And it's harsh, yes, but life is a PvP game. You either play by the rules and you win, or you follow the crowd and you lose. So now let me tell you what rules you need to apply so that you can win. So here are the rules that you need to apply to make money during a financial crash. Now, I should preface this by saying this is not financial advice and you should do your own research, but these are principles that I apply. First and foremost, this works best if you position yourself before the crash. So now is the opportunity window. And reduce your debt so that you're not a forced seller, because you want to be the one sweeping everything up rather than the one having to throw everything away for pennies on the dollar. So key rule number 1, do not follow the crowd. If you're in the business of trying to make money, never follow the crowd in a crash, as it's just fatal. So index funds and real estate will not save you in a crash. Both will tank. That is my prediction from now, and we'll see if I'm right. And the solution that I propose is gold. Gold is battle proven, and historically throughout every single crash, gold has always come out on top. And in fact, paper money has always not. Paper money always goes down. Fiat money is worthless. And I want to explain this relationship to you. If you keep track of gold versus the dollar, you'll see that gold versus the dollar has been, quite frankly, kind of exponential lately. And people think that this is the dynamic. People think that gold is going up and that the dollar is staying the same. But no. Gold is marginally increasing like that, but the dollar is just tanking and it's basically near zero. In fact, the dollar's lost 97% of its value since the inception of the Fed in 1913. And if you want even more leverage to this, you should get gold mining stocks. So for example, one stock, if you want to see just how profitable this is GDX. GDX is up basically 40% this month. Now, have a think to yourself, how long would it take you to get 40% from your bank? Well, I can assure you that 10 to 15 years may not even cut it, because you may have to pay some taxes on that if you've got a decent sum of money. And now that we've covered the fact that gold is battle proven, the gold versus money dynamic, don't follow the crowd, silver is also another safe haven asset. But silver is more volatile and you have to pay taxes. And let me expand upon this further, as I just remembered that I missed a few things with gold. So with gold, what you can actually do is you can buy, if you don't decide to get mining stocks, which is quite risky, I should warn you, if you decide to go down that route, that is quite risky, very volatile. With gold, you can buy something called Britannicas. And what they are 1 ounce coins. What this allows you to do is to buy a coin where you pay no capital gains tax if you're profitable on it. Whereas with silver, if you were to get a coin, you have to pay VAT. And just that 20% alone basically means that you're minus 20% from the get-go. So gold is much better than silver in these times. Also, in terms of the gold versus money dynamic, specifically the dollar, because of how it's pegged to the dollar at the moment. Obviously, it's not actually pegged to the dollar, it's free floating, but it's traded against the dollar. During times of uncertainty, such as this incoming economic crash, what happens is people sell their index funds and the money goes straight into gold. So this flight to safety causes gold to actually increase even further in value. And I think that's completely realistic for gold to hit $10,000. So you heard it here first. $10,000, in my opinion, given the way things are at the moment, is completely realistic. Also, in relation to gold miners, the bullishness on the gold mining indexes recently had reached 0%, which meant that no one was buying them. And yet, the gold miners were actually doing most of the heavy lifting in the S&P. And these companies are doing very well for themselves as they have a lot of cash, they're investing it right, and not only do they have a product that's increasing in value, but they also have a sound business plan and business model. Hence why I think that they're far more attractive than any index funds, as even though the index funds have been increasing lately, if you're in it for the long game, I think that this is the way to go. But again, this is not financial advice, these are only my own personal opinions. And various other stocks, but this is only one that I've mentioned, one gold fund that I've mentioned. Also, understanding the fundamentals means that you understand that you need to be shorting, but it's very important to time it right, as a lot of people also understand that the economy has to collapse, fundamentally speaking, but they've messed up the timing so that they've been, quite frankly, burnt quite heavily. As if you mess up the timing when they're forcing stock prices to increase even further, you'll be cooked. So it's very important to get your timing right if you decide to do this, but this is extremely, extremely risky. Even Michael Burry, who earned 100 million in 2008, he was almost margin called. Now, what does that mean? It means that he almost got his position wiped out, they almost hit his stop loss, and he would have lost money because he had actually timed it a little bit too early. And this is something that you need to bear in mind. The fact that the market can stay irrational much longer than most people can stay solvent. So now, with all these rules being said, we're going to now learn how to profit after the crash, as a lot of money can be made there too. So how to profit after the crash. Now, whether you've made money during the crash or if you had money before the crash that you've managed to keep, this will be your greatest advantage. You need to have capital to actually take advantage of what's about to happen. So what typically happens is people become very desperate. Now, why do they become desperate? They lose their jobs. When you lose your job, you lose your income. Money stops flowing in. So what do? They typically start selling the most expensive asset they have, which is real estate. So what's the advantage if they're desperate? Well, when someone's desperate, they're more likely to negotiate. And when they're more likely to negotiate, what does that mean for you? Exactly. That means that you're more likely to get a better offer. So instead of paying, say, 200k, you might be able to get it for 150 or 100k. And then what this will allow you to do is after the crash, you'll have assets that you can use to generate income with. Basically renting them out, being a rent seeker. But since that's the game, don't hate the player, hate the game. And a very important thing that I should teach you is that do this in stages if you decide to pursue this strategy. Again, not financial advice, but I'm just saying that when you do this in stages, this will allow you to sleep better at night because no one knows when the real bottom of the market has been reached. And in fact, an ex-investment banker told me that by doing this in stages, this will not only help you sleep better at night, but this is exactly what the banks do themselves. So this is a proven method. Also, something that's somewhat related is buying undervalued assets, because typically when the stock market crashes, there are still some companies that fundamentally speaking are sound. And as is the stage with real estate, again, doing this in stages is much safer. So for example, if the stock, say, is currently $4, it's much better to wait. It might go down to 380. You buy a little bit more then at 360. Then you wait for 340, but it never came. And then it starts going up. You'll feel much safer like this because your average position size is $3.80. Whereas if you went all in at 4 and then it went down to 380, you'd feel like an idiot. And also you might not be able to sleep at night. Stress from these things can literally drive people to insanity. So you have to be careful and you have to understand the risk that you're assuming. You have to respect the risk and understand the risk. And as I've written here, nobody can catch the bottom. But what you're trying to do is you're trying to get low enough or cheap enough, right? And you need to be able to handle the drawdown. Now, what is drawdown? It's as I stated here. So if you were to buy, say, at $3.80 and it went down to $3.60, obviously that's 20 cents. But if you put in a substantial sum, say $50,000 or $100,000, we're talking about a lot more than just 20 cents, right? So you need to be able to weather that drawdown and to be very confident that what you're buying, fundamentally speaking, should go up. You also have to understand that this may take months or years to recover. So you also need to be bearing that in mind too. But with these things that I've left you with, I think that this will leave you in a better position than before this video. If you got any value, let me know. In the next class, we're going to cover housing and to understand why Q4 of 2026 will be the peak of house prices and what do I expect is going to happen and how you can take advantage of what's about to take place. If you have any questions, leave them in the comment section down below and subscribe.